Good morning, everybody. I want to thank you for attending the Place Your Trades Network Spaces to discuss LNG and behavioral finance. This Spaces is brought to you by TraderBait, which has a custom web app dedicated to trading CME Group's new daily option contracts, including indices, energy, metals, and now Bitcoin. You can also trade these on the DOM on TraderBait's main platform as well. They're a great way to get exposure to the futures markets with limited risk. You can use the link in my Twitter stream to get the TraderBait app for free. I also write a weekly blog and a daily pre-market overview on the broader markets that you can subscribe to at placeyourtrades.com. That is absolutely free. And then I will be doing a summary of this episode with my key takeaways that will be available to download as a PDF. So if you're interested in getting this PDF, I'll put a link in my stream at the end of the spaces. And you could just click on that or visit placeyourtrades.com/spaces to sign up for it. And then the PDF overview will be available and mailed out tomorrow to anyone that signs up. Now to introduce our guests, we have Peter Atwater. After helping several hedge funds successfully navigate the banking crisis, he decided to have a change in career, and that turned out to be studying confidence. Tossing aside his academic training in economics and his experience on Wall Street, Atwater turned to social psychology and discovered not only do we act as we feel, but we do so consistently too. To paraphrase Mark Twain, history rhymes for a reason. Today, Atwater is recognized as an expert on the impact of confidence on individual and group decision-making. He teaches classes on the topic at William and Mary, his alma mater, and for the honors program at University of Delaware. When he isn't in the classroom, you can find him speaking on stage, on Bloomberg, and in the Financial Times, Wall Street Journal, and Time magazine. He's in his new book, The Confidence Map, Atwater shares tools and insights he uses to work with business leaders, investors, coaches, and public policymakers. Next, we have JoshCrumb, who is the founder and CEO of Abax Technologies. JoshCrumb is, I already said that. Prior to Abax, he was co-founder of Gold Money Incorporated and has served as Chief Strategy Officer and Director since 2014 and its Chief Financial Officer since 2017. He was previously an executive director at Goldman Sachs, the senior metals strategist in global economics, commodities, and strategy research division in London, a co-founder and chief financial officer of Coffee Flour, and a director of corporate development at London Group of Companies. Josh holds a Master of Science in Mineral Economics, a graduate certificate in International Political Economy, and a Bachelor of Science degree in Engineering from Colorado School of Mines. Last but not least, we have Thomas George, who began his career in 2002 at TD Asset Management. He's held various roles, including head of resource investments and portfolio manager of the TD Resource Fund, TD Energy Fund, and TD Precious Metals Fund. He is currently the co-manager of the Grizzle ETF, Growth ETF, sorry. I can't speak this morning, guys. All right, so how we do this, since Peter and Josh haven't been on my spaces before, we do this in a round, so nobody's sitting not talking for a long time. If you have any comments on anybody else's comment, please feel free to do so. If roundtable discussion is fantastic, but I'll leave that up to you. And we'll get right started. So I'll start with Josh. So Josh, really, this is a space about LNG, how do you see the current market for LNG as far as longevity? Because we have the West saying we want fossil fuels out by 2030, 2035, 2050, whatever the goals are, while the rest of the planet is, making 30-year deals.
Hi, Tracy, and hi, everybody. Thanks for having me here. Your timing actually was quite perfect, sitting at the Global LNG 2023 conference in Vancouver right now, an annual gathering of all the major energy companies in LNG. And I would say it's not too different than the rest of the commodity market right now, where the conference is generally pretty bullish. We've had a renewed investment cycle looking to get going, based on the not the energy transition, energy security, with energy security really being what's driven the LNG market, of course, after the flows of Russian gas stops. So there's an overall bullishness in the industry. However, that really conflicts with what's actually happening in capital markets. So this is sort of a theme, I think that will continue across commodities, particularly given the cost inflation of actually, building real things. Even after the bullet.
Did you cut out? Can anybody hear me?
Yeah, sorry.
Oh.
My iPhone limits my time on Twitter a day, and it cut me off. So, sorry about that.
You're hitting the breakers at 11 a.m.
Well, I only have a 30-minute limit for the day. So, but anyways, so. Yeah, so I mean, it's a similar theme to across the commodities space in that the market's really not pricing what needs to be actually built. My former colleagues at Goldman just put out their 20th anniversary of the top energy products report that's done every year. And really the incentive price needed for LNG sits probably around 10 and a half, $11 an MMBTU landed in Asia. And if you look at well, there's a whole longer discussion on what the actual price of LNG is, which is the biggest problem, and of course, what ABEX is working on. But really, the assessments that are out currently don't really have a price that justifies building capex. So this is, I think a common theme across commodities. There's a narrative, and then there's the market price, and the market price isn't really supporting building anything at the moment.
Absolutely. So, I mean, and kind of wanted to get your just thoughts, kind of as a side note or a sidebar. What are your thoughts on Berkshire Hathaway agreeing to purchase 50% stake of Cove Point for $3.3 billion in cash? I find that interesting. Warren isn't in it for anything very short term. So what do you think he's seeing that, say, governments are not?
Yeah, well, obviously a legendary investor that really knows how to get into sectors that have, high barriers to entry and are quite strategic. So I think this, much like his investments in other energy infrastructure the past few years, I think it makes perfect sense. And that's also combined with investments in the big Japanese trading companies. So clearly Warren Buffett sees, value in the hard parts of global energy supply chains. We totally agree with that strategic approach to investing long term by investing in those key bottleneck areas.
And what are your thoughts, since you're in Vancouver now, I might as well ask you, what are your thoughts on Canadian LNG? Because there was just an article out today, I think on Bloomberg, saying that, there's not going to be any demand for Canadian LNG because they started, it's too little too late in the cycle, and nobody's going to be using LNG after 10 years.
Yeah, I mean,
is basically what the article said.
Yeah, just more, complete, crazy talk. Look, I mean, LNG, Canada, it's really a national, you and I both are Americans that spend a lot of time in Canada and have a lot of friends and colleagues in Canada. It's just really a shame. I mean, Canada should have been exporting LNG 20 years ago. And the fact that we're only going to get some exports probably starting in 2025 is a real shame. And again, there's a lot of narrative, but even at this conference here today, we heard a lot from the First Nations communities that want this. I mean, it makes perfect sense. So, this concept that there's a lack of LNG demand is totally crazy when, probably 40 or 50% of global energy still comes from coal. So that's pretty much infinite demand to replace as a cleaner energy source. And of course that, the LNG exports from Canada really should be going to, a global population of, 5 billion people in Asia. So the fact that you've got these nonsensical policies, really being driven by, a small population sitting on a major landmass is is a bit ridiculous, and it's nice to see that both First Nations and I think the LNG projects in Canada, finally starting to take off.
And do you think we'll see more expansion, or is this probably the current projects that are in the works right now? Do you think? I mean, are they looking to expand more than, because it's capacity, but not a lot of capacity.
Yeah.
So do you think?
I mean, I think LNG Canada will be a good start, and again, I do think in the long term, pragmatism will prevail. So yes, I do think it'll expand. Of course, pipelines and accessing the gas is the bigger issue than necessarily the export facilities. But I do think this is an opening that hopefully will expand over time.
Excellent. And then we'll move to Thomas. Shortly, we'll come back to you, obviously, Josh. So I know that you guys over at Grizzle are very bullish nat gas and LNG. So what are you guys seeing in this market that makes it particularly enticing?
Hey Tracy, yeah. So I just posted an oil and gas oil and gas ratio, and our big our big thesis very simply is that we need a bridge fuel to to a world where emissions, be it particulate matter, if traveling through Asia, that's obviously a feature, is the pollution and air quality, and that you can put aside CO2 and global warming, but this part is real, right? And natural gas has a definitive role to play there. And secondarily, we think that ultimately you get to the promised land is nuclear, but you need that bridge fuel right now, and we don't think that there's any fuel that has a better trade-off for environmental limited environmental impact, and deliverability globally, LNG particularly, than natural gas. So from our perspective, we're very bullish. We put out a Substack, waiting for the natural gas payday with a life jacket on, and the idea is, yes, prices are depressed, but our view is that that if you take a long-term view, you'll get paid handsomely, and there are a lot of interesting, we're stock pickers. There's a lot of interesting stocks that pay actually particularly juicy yields, that that have pristine balance sheets, that will be able to weather the storm and then enjoy the payday.
Well, that was kind of my next question is, well, what's it going to take for, everybody's waiting for, not only actual gas prices to move higher, but, for, these equities to move higher. So what's it going to take?
Yeah, no doubt. I think we're seeing all the right signs, right? Like, if you think about what happened in Europe and how quickly Europe was able to pivot from pipe natural gas to LNG, it just nothing short of incredible, right? And that to me is really the excitement, forest from the trees. Big picture here is that LNG is a real global commodity that can alleviate real energy crises in energy time, in almost real time, right? Like to do that in a year, it's just incredible. So I know Margot's in the audience. She did a phenomenal series for LNG 2023, where Grizzle was a proud pre-conference, to help spread the word about LNG 2023, and we went through all of it. It was just an incredible amount of data that we are looking. When you look at Asia and their long-term buying, their continued long-term buying, particularly China, that I think you just need to hold the course, and make it through to that point where export capacity continues to grow out of the U.S., and hopefully we see sizable increases in Canada as well, and that's all that you need.
And then, because I'm kind of going to ask the same question, but since you are in Canada, what are your thoughts on the Canadian LNG market?
Yeah, so Scott Willis, who's our in-house natural gas expert, would definitely have specific views there. But I definitely am more hopeful, and I believe we're seeing real movement, and I think the political landscape will change. for the better. I think it starts there, right? I think we're going to get to a place where politically we're going to have to do what Canada does best, and that's export resources. And we're in a fortunate place to have one of the world's largest resources of natural gas. It's nonsense that we're not doing it in sizable way, right? And breaking through all the red tape. I think it's all there, and as Josh mentioned, right? You've got indigenous groups that are all for this as well. It's just a matter of time. Obviously, sooner is better than later. I take definitely the hopeful stance, versus some of these, the headlines that I just think, we can. I think on the ground, the support is definitively there.
That is good news for certain. We just need to do something about the Prime Minister of the
Right.
Okay. And then, sorry. All right, moving on. Sorry, my computer just glitched out. So I'm gonna come back to you, Thomas, and then moving on to Peter. First, let's talk a bit about what is behavioral finance for those people that don't know, just to get a general background of even what it is.
Yeah, so I think of behavioral finance as being the connection between how we feel and what we all do in the markets every day. So it's the psychology behind the choices we're making.
Right. And so what is, you talk about, you have a new book called The Confidence Map, and you talk about collective mood versus individual mood. What, can you kind of go into that a little bit?
Sure. And let me apply this to the discussion at hand. We're all talking about natural gas. And so if we think about a year ago and the response to the invasion in Ukraine, nat gas became the instrument of choice for people to speculate on the panic of the invasion. And so we saw intense vulnerability, which is the opposite of confidence, which the commodities market really trades on, just spike with prices mirroring it brilliantly. And so you could see investors just immediately race into anything they could in energy. And what's been so interesting, Tracy, since then is nat gas has basically been a proxy for sort of the East versus West focus in terms of who's winning the war. And I think it's not insignificant that we've seen this humiliation of Putin coincident with a major low in nat gas prices. And this is, to me, something that I think investors need to pay a lot of attention to, which is the symbolism of what they're buying and who does it matter to. And so nat gas, to me, has been a wonderful study in behavioral finance this past year.
And then I want to expand on that a little bit. So it seems obviously we had that energy spike in summer of 2022. Since then, energy prices in general have come off considerably. So, and the theme this year, the ongoing theme this year, it seems everybody's waiting for this recession to happen. That hasn't happened. And it's obviously particularly affected markets as far as sentiment goes, particularly in the commodities markets, I should say. Commodities markets, in particular energy. And so what we have seen is the physical market has been quite strong, and it's been very divorced from sentiment. So kind of what is the psychology behind this? Because it really, has had traders kind of scratching their heads for months now.
Yeah, a couple of things. One is panic is unsustainable. And so what we typically see after a panic is the kind of price behavior that we've witnessed in natural gas, that the intense vulnerability, the demand that arises from that exhausts, and then you see prices return to a dramatic low thereafter. There's another element of this that I think is worth talking about, which is at the same time we're seeing intense disinterest in real assets like energy, we're seeing this fantasy in AI. And one of the things that I find over and over is that we have this sort of trolley car ride as investors from wanting things that are absolutely certain and are real to things that are wickedly futuristic and abstract. And so I think that if we think about this cyclically, this mania in AI and this the fact that we now have to rebalance the cues suggests to me that we're likely to now see a growing disinterest in abstraction and much greater interest in real assets like natural gas and oil and other energy commodities.
Well, that's probably music to everybody's ears on this particular spaces. That's what we're looking for. And then in your book, you also talk about when consumers' feelings of certainty and control, not price, drive demand. Is this the same true? Does this hold true for market participants as well, not necessarily just consumers?
Yes. Yes, I mean, you can see that, in the equity market, price mirrors sentiment. I mean, you can use stock prices as a brilliant barometer of sentiment, and they're the ultimate Giffen good. The higher prices go, the more we want things in the equity market. Commodities work in the other direction. Commodities, to me, are a vulnerability trade, and the issues of scarcity versus abundance really flowing into what we care about. So, when I look at the nat gas prices today, what they're telling me is the crowd thinks that there is this enormous abundance and that scarcity is the last thing in their minds. And that, as we've seen, can be disrupted by geopolitical events at any turn. And particularly with the humiliation of Putin, I think we've got to be thinking about, if you're the kind of political leader that he is, those are headlines that really strike a nerve.
Absolutely, absolutely. Wonderful insights. Wonderful. Well, we're going to go back to Josh. So, Josh, let's talk about ABAX here for a little bit. You're going to kind of talk to us about ABAX and what you guys are doing that's different, particularly with regards to the LNG market, because I think it's very interesting.
Thanks, Tracy. Yeah, well, I think it plays a little bit into the theme that Peter was just talking about, in that we believe that we've probably gone too far in financialization and abstraction, including our major exchange groups. So, when we look at the growth commodities, call it energy transition or a renewed focus on an energy security cycle, what we see is that there's a number of growth commodities, LNG being the major one, but also metals in the battery supply chain like nickel sulfate, and of course ways to deal with the carbon externalities like carbon credits. So there's a whole series of new commodities that I think are going to be headline commodities that maybe weren't in the last investment cycle, but a lot of these are lacking prices. They don't have prices defined by buyer and seller of last resort, physical markets, the great markets that made the U.S. energy market, the most robust in the world, like Henry Hub natural gas and WTI, crude oil, New York Harbor, products. So we think that same robust market infrastructure is needed for things in the global commodity landscape, like liquefied natural gas, like battery metals that don't have proper benchmarks. So what ABAX has been doing is building, essentially like the old NYMEX, building that for global markets and particularly in the growth commodities that don't have prices like LNG.
And then how does like the ID plus plus fit in there?
Yeah, so there's really three themes that we invest again, why we believe that a challenger exchange is needed. And the three themes are really the continual move of commodity, both supply and demand, to Asia. And so more and more origination and trading, moving from places like Houston, New York, or London, to places like Singapore. That's one piece of it. The second, of course, as I just mentioned, is the need for physical commodities and not just financial abstractions and cash settled futures. And then the third is technology. And look, the history of markets has always kind of run in parallel with the history of information technology and computing. And we think that there's a whole nother level of technology coming, not necessarily in the trading and matching and the high frequency trading. Obviously there's been a lot of investment in that field and getting liquidity and price discovery from every corner of the earth electronically. I think that's done well on the front end, but on the back end, things like using commodities as collateral in financial transactions. That's where we're investing a lot in technology. Is if you can open up commodities to being better collateral in financial markets, it will really change everything. And so I think so we're investing in both again the continued move to Asia in our commodity markets. We're investing in the new growth commodities, and we're investing in the technology that will better allow these commodities to be used as collateral in the financial system.
And then since we are talking about Asia, we kind of are we seeing kind of a move from the West to East as far as, fossil fuels in general are concerned, I guess we'd say, or, energy? Because it seems like, we're seeing like deindustrialization happening in Europe. It hasn't gotten to the United States yet, but yet we're seeing increases, in Asia. I mean, China just overtook Japan as the largest gas importer. Does this continue? And then, what are your thoughts on India as well?
Yeah, absolutely. And again, this is all driven by demographics on the demand side, of course. And look, there's nothing new to this story. This has been really what's driven the commodity investment cycle for the last 20 years. But I think one thing that is a little bit different on the move more towards Asia is also the supply side. Again, I think take nickel for example. Most of the entire battery supply chain for that matter, it really is a story of investing in project development and resources in a way that frankly we just haven't been doing in call it the G7 countries. So demand has always been a key part of the story, but I think increasingly you're seeing the supply and the trading moving to Asia as well. Tracy, I think you're still on mute if you were
Oh,
asking a follow-up
what?
question.
I'm still on mute. Oh my God. I'm with it today. All right. So I know we're here to talk energy, but being a gold guy, I have to ask your thoughts on gold because everybody's talking about it, has been talking about it. Everybody's waiting for this breakout. So what are your thoughts on gold, near term, middle term, short term, long term, any
Yeah,
term?
well, I think in the Western financial markets, I think there's been not as much interest in gold, other than the first, sort of spikes with the energy markets and volatility around Russia's invasion of the Ukraine. And really since then, I think people have wanted, in broad financial markets have wanted to hate on gold, but there's been a strong bid from central banks and a strong bid from the East, buying up that market. So, we saw it drifting off again earlier this year, based on interest rates. but I think, particularly with the data over the past week or so, you're seeing you're seeing a bid for gold again on the rate narrative. But I think longer term, I think you're going to continue to have a strong bid for the monetary aspects of gold in central banks. We can kind of go down the rabbit hole if you want of sort of a bifurcated world, and using gold more as a settlement currency, which seems to be happening. Well, at least there's a lot more talk of that happening. And then I think I think the final sort of bullish, long-term driver for gold is energy. Again, I still think that we're still, majorly underinvested in energy infrastructure, despite some of the bullish talk over the last 18 months. We're still, massively underinvested in global energy. And gold, the cost base of gold is going to continue to go up on the cost base of energy. So, I think long term, I'm still structurally bullish, mostly on the energy story, and increased demand from central banks.
And can you go on? Can you kind of go into a little bit more detail what you mean by kind of the energy gold correlation there?
Yeah, so I've done a lot of work over the last 10 years, published some of this research at Gold Money. I've always seen gold essentially as an energy commodity, because because of the cost base is actually of all of our sort of natural resource commodities. Gold has the highest energy cost base. Over 50% of the cost of gold production is direct, sort of flow energy consumption. So now it's very different than other energy commodities, and that it's very cheap to store. So once you produce it with a very high energy cost, it's got a very low energy carry. It doesn't cost a lot to store gold, unlike storing natural gas or oil or coal, or other commodities. So so as you raise the cost base, right? The old marginal cost for oil was $20 a barrel. Now it's probably $80 a barrel, which means the energy basis, the cost base of gold keeps going up and up as well. So and I think that we're not even pricing in any real decarbonization. There's been much more narrative in the energy transition and decarbonization as there has been actually prices. If we actually wanted to price decarbonization into commodities, all of our energy infrastructure and all of our energy prices would be much higher, and that goes for gold as well.
That's very interesting. And so when you talk about, we'll go into this bifurcation just a little bit, because it's a hot topic, and you brought it up. But what are kind of your thoughts? I mean, we are hearing, maybe, perhaps, I don't know, there might be a BRICS currency that is backed by gold. I mean, is that even possible, even if you reprice gold?
Yeah, operationally, I don't think it's near term. I don't think we have the infrastructure to do that. I'm actually going to be on a podcast with Grant Williams and Luke Roman talking about this next week. But I think operationally we don't have the infrastructure there. But it's much like the Euro project from sort of 25 years ago. I think the demand for collateral in the financial system that's not just U.S. Treasuries is very real. And across Asia, that's been demanded for a long time. So I think this is just an ongoing transition of what we use as collateral in the financial system, and I think more and more it's going to shift towards hard assets. So over the short term, do I see gold demand as a currency and settlement in a BRICS currency? I really don't think operationally we're anywhere close to that. But I do see more and more, financial collateral being the form of traded commodities, which again kind of plays in some of the themes that Abex is investing in as well.
Very interesting. Thank you. And then we'll move back to Thomas. Let's talk about, so where kind of do you see the current supply-demand situation in the LNG/gas markets, and where do you see the biggest growth areas, geographically speaking?
Yeah, so I've put a few things in the nest, and just in terms of visualizations, some of these came from from the videos that Margot did, and some from the recent Substack. But I think what's interesting is we found this. It was like a data table we created into a visualization. It's the second picture in the nest: LNG total proposed and construction. This is capital in total. I'm just going to pull it up here. And so we're like, these are big numbers, right? And obviously proposed is, that potentially may not come on, but just in terms of how quickly, how meaningful China has been in the long term, LNG market has been incredible. You got $72 billion coming on there. Vietnam at 8, Thailand at 4 billion, and India at 10 billion. One thing that really stuck out for me, we had a great interview. That would be last year. This is when energy was still bubbling, and particularly natural gas. And Margaret and I interviewed Lee Gehring from Gehring and Rosenzweig, and Lee Gehring put something really into perspective here, and I kind of want to focus on this pictorial because it kind of tells you everything. It's this. And I know Doomberg has talked about this at length as well. Just Doomberg calls it the energy density ladder. But at the end of the day, as countries continue to get richer on a per capita basis, their propensity to move from coal to better, cleaner forms of fuel, the next rung after coal is natural gas. Is that by definition is your next step. So if you continue to believe that the East will continue to develop at a rapid rate, and per capita income will continue to grow, you have to be bullish LNG. And so who's going to be the supplier? I put that graph over as well, and I think there's no better supplier than the U.S. Right, and we're sitting on an incredible bounty of relatively low natural gas, low price natural gas relative to globally, and I think that will continue to get sent out, and so. What Lee Gehring was saying was that you ultimately get this price convergence, right? And right now, you want to play that hard. Of course, I do want to buy hand over fist natural gas in the cheapest basins that is going to continue to grow export capacity. I'll put another graph in the nest on that. But just a pictorial here, which is kind of phenomenal. U.S. LNG exports to Europe, like basically you just kind of see this. Obviously, this is shipments that some of that shipments would have gone to Asia, but this is just how quickly they can send cargo to Europe during an energy crisis. It just is pretty phenomenal. How important America will be, in Canada as well. And I think you're going to look at the West supplying the East, and that's the narrative that we're playing.
And of course, the ultimate question is, of course, that since we brought up Europe here really quickly, do you think that Europe's, because their storage is full, they're getting a little complacent, they're, heading back on this green path, that this is going to, pose a problem for them if they have, another terrible winter, or, something else happens, who knows, geopolitically, where they're in trouble? Do you think they've become too complacent?
Yeah, no, I think you've nailed it, right? And I know Peter touched on as well, like just kind of like what's the. It feels like right now overall the pricing yes, natural gas, there's complacency everywhere, right? Like you've got complacency in terms of Europe saying, we averted disaster, but business as usual. We'll continue to close down nuclear plants and chop, like whatever Germany's doing, right? It's kind of like it's carnival land, and at some point the music stops, and the clowns are like left with face paint and dripping off their face. What's going on? And you just realize, like, wait a minute, energy is life, right? And that's Doomberg. That's the Doomberg headline quote. And you kind of have to think that right now, as a and we're betting on the market always, right? I, and I know Scott's in the audience as well. We discuss this continually, right? We look at the bets across our board, across our portfolio. What we really like, we have a heavy bet on AI, of course, and that for us is it's the growth side of our barbell. Now, obviously, there's so much, there's clearly hype and excitement. We believe that that's warranted, but then the other side of our barbell is commodities, which we like as well. We believe, but the part of it is we believe both are in structural growth trends, right? And when we look at that side, the natural gas side of this, is that when we compare this to everything else, I don't think we had a commodity bucket, and we obviously buy the underlying stocks and the stocks themselves that have such a skew to things, to prices surprising to the upside for all the reasons you just stated, right? If it ends up becoming a worse winter than anticipated, or all these other things, like right now you're priced to perfection, that the market is saying there's no future in natural gas, and that to me gets us very excited. We don't know if it'll be this quarter, next quarter. It doesn't really matter. Like we believe in the 2-3 year view. And coming back to the point you made earlier regarding Berkshire Hathaway and them buying LNG terminals, like that makes a ton of sense. That to me. They're analyzing the market. We are, I want to be with the hands that are steady in this for a long term, buying businesses.
Absolutely. I am 100% with you. So, and then we'll move to Peter. Let's get back into some, what drives markets, what drives the market. With that, what does drive our interpretation of data, particularly market data?
Yeah, so I think all market data is like, numbers on a thermometer. We have to decide whether things are hot or cold. The same 65 degrees can feel warm one day and cool the other, but it makes a difference. Do we grab a sweater, or do we throw on shorts? And you could see that today with the CPI data. I think we have to appreciate, particularly in the energy sector, that policymakers are doing the same thing. And to the point that was just raised, if we start to see energy prices rising again, you'll start to see policymakers turning attention back to national independence in terms of energy supply, and a lot of the rhetoric that we saw last summer will be front and center. And so all of these feelings get reflected, particularly in the commodity space. I mean, we talk about energy here, but we can turn, if you turned attention to food commodities and the inputs there, policymakers become incredibly sensitive to the data. And you could see that with the Biden administration with the Strategic Petroleum Reserve. So if I'm investing in the commodity space, I need to realize that if prices are expressing complacency, policymakers are mirroring that complacency entirely. If we see intense vulnerability, policymakers will be reflecting that as well.
Excellent. And then you talk, I noticed a tweet of yours that I found really interesting. You talk about today's extreme hear me now mood in the markets. What do you mean? What do you mean by that?
Yeah, so if you look at consumer sentiment, it's still pretty grim. And with that comes a mindset where the only things that matter to us are ourselves, right here, right now. If we're on a plane and there's turbulence, what's happening off the plane doesn't matter to us until the plane ride becomes smooth again. And so if I look at investor behavior in pretty much everything right now, the time horizon is today, thus the interest in all these 0-day options. And so nobody is paying attention to the future other than in very abstract terms. and thus you see that on the AI side. But I think we as investors need to be particularly aware that with this me here now mindset comes incredibly impulsive and emotional behavior. And one of the things that I feel like a broken record on is investors need to appreciate that the speed at which a change in feelings can be moved into the market and into the real economy is like nothing we've ever seen. And I think we now have almost a mark-to-market economy, and we have a mark-to-mood market. And earlier this year, we saw with Silicon Valley Bank what happens when a crowd becomes disrupted and money moves so fast. And we should expect, and I encourage people to size trades with this in mind, that, if we get an exogenous event, and the crowd and all knees sort of jerk at once, you'd better be prepared for the market price moves that reflect that, given how me here now people are. We're already on edge.
Right. We're seeing that with like zero DTEs, right?
Oh yeah. Yeah, they're the ultimate lottery ticket for people who are in that me here now mode.
And then, so the next question I wanted to ask, so how can we kind of use this information kind of to make a better or more well-rounded decisions in this market? It's like, what should we study as far as the psychology behind, these decisions?
So I think that particularly in the commodity space, price is telling you everything about psychology and the feelings of vulnerability or confidence that exists broadly, the feelings of scarcity versus abundance. And so I think that if I'm in that space, I've got a very simple tool on my screen that is telling me exactly how people feel, the stories that I'm likely to hear, and more importantly today, the decisions that are likely to be made by market participants and policymakers all at the same time.
The markets are so the markets are still telling us they're the collective mood is not good, right?
So it again depends on where you look. I mean, in AI, it's like la la land. In commodities, there's a sense of abundance seemingly as far as the eye can see. So we've all but taken geopolitical risk off the table in the energy space,
Which is quite amazing. So do we just wait it out? I mean, because I'm going to admit, most of the people probably listening to this spaces are commodity investors, particularly energy. So what is your advice for investors?
Yeah, I mean, my advice, is to recognize that, we're in a moment of complacency. How long that moment lasts remains to be seen. To me, if I'm thinking about buy signals, it's, some sort of peaceful resolution to Ukraine would suggest enormous euphoria, complacency, could mark an even lower low. I continue to think that we've all but forgotten the geopolitical risk from last year, and the humiliation of Putin significantly raises it, and folks should be aware that to me remains a potentially significant upside price trigger.
Well, that's good news or bad news. How you look at that one. And so really what we're going to do is we'll do kind of our last round here. And the last round's kind of the same question, well, is the same question for everybody. And really it's, talk about something that you want to talk about that we haven't discussed yet, or, kind of your overview on the market or I should say, you can do both, and or kind of your overview on the market, say the next 12 to 36, 48 months out, and what should we as investors really be focusing on right now? And Josh, you're up for that one first.
Sure. I guess, following on the comments from Peter and Thomas, be like Buffett. I can tell you when I was out talking about LNG being the future of, global energy in 2018, I didn't have a lot of listeners. That's for sure. And of course, we were, well ahead in building infrastructure into what we think is going to be, a fantastic market for LNG over the next, at least over the next decade. And when just thinking about where do we position ourselves, just even as an entrepreneur and a capital allocator, I looked at the market infrastructure. If you go back and look at in call it 2005. If you invested in, an energy major, you invested in a barrel of oil and the price of oil, or you invested in an exchange, like the IPO of the NYMEX, I think the exchanges have vastly outperformed, other parts of the commodity infrastructure because they're, such capital efficient businesses. Right? We can build a $1 billion business in what we do in markets, for far less than $1 billion. Whereas, energy infrastructure, again, not that it's not important and we critically need to invest in it, but there's a very different operating leverage in being the exchange provider versus being in the physical infrastructure. So we invested, very heavily in that theme. But maybe one other point, going back to how commodities can change and can change quickly. I think we need to be very cognizant of the period of volatility we're going to be going through. Natural gas is the perfect example, right? Right now, relatively low prices, other than a small, June spike in U.S. natural gas. We've seen, European and Asian gas prices, drifting lower for, pretty much the entire year. But that can change very quickly because we don't actually have very significant storage infrastructure. Even in the U.S. in very robust markets, we're not investing in new storage capacity in onshore U.S. gas. And we have very little storage capacity in LNG or gas in Asia or in Europe. So people focus a lot on the inventory building, but very quickly things can change. And I think the the investor community overall is really not used to this type of volatility, right? When the investment cycle of the last 10 years and technology stocks and low interest rates and kind of call it the everything bubble, it didn't, it was essentially the central banks dampening volatility for a decade. And now that we are still in an inflationary environment, they don't have the tools to dampen volatility. So I don't think investors are used to the volatility. I think we need to have a mindset and understand that we need to make the bets like Buffett and not always just chase liquidity if we want to make the long-term returns. And we have to be able to understand volatility to be able to stay in the game in this upcoming commodity cycle. So I think those are the things that I would leave the audience with.
That is fantastic advice. Fantastic advice. And I think that that's really important that you pointed out that we are in a period of volatility that, we haven't seen, many new traders don't know any different. So I think that's great. And then Thomas, you're next, but I put a link to the PDF up in the nest if anybody wants to sign up for that, by the way. And so Thomas, same question. You can talk about anything that we haven't discussed yet, and or what investors should be looking at in this market, and what should we be focusing on for the next 12, 36, 48 months?
Yeah, thanks, Tracy. Yeah, great discussion today. And I'll just bring it back. And I thought, having Peter here, the psychology of the market, and we're always at the cross section of fundamentals, data, and psychology, because psychology is what impacts valuations, because they can be disconnected. And one thing, having Twitter is incredible because you have a community and you can poll the community. I put a poll up that I asked about a month ago. And I said, what do we see sooner, $100 oil or $3.50 natural gas? Basically, it was the same percentage upside at that point of either of those, right? And what was interesting, we got nearly over 700 votes, right? What was interesting is that 60% or 58% of those that were polled said nat gas would would get to 350 first, versus oil hitting 100. Psychologically interesting, right? But then I posed, like, this is a fascinating result on the poll, given that more people see better upside in natural gas. Here are my two questions. Are investors overweight natural gas in their portfolio relative to oil? My hunch is no, right? And if we're to look at the broad FinTwit energy, and Tracy, you're right at the vortex of it. You see it all. You see that. I would definitively say FinTwit energy is dominated by oil, right? And so when I think about where I want to be fishing, and where I want to make a bet, A, on a commodity, and B, on the underlying, I think the conversation volume in Twitter is a high indicator of less due diligence done on natural gas fundamentals and on the underlying stocks themselves. So that gets me very excited. And then when you move to the oil and gas ratio, we're at historically a strong indicator for outperformance of natural gas stocks relative to oil stocks. And then in our quant study, we get into that to say, okay, listen, we don't know if it's going to be next quarter or 2 quarters away, but what are the stocks that are going to get me to the promised land? And the promised land being greater than $4, per BTU, right? And so I think, that's the construct we think in. Thinking, do I have an opportunity here where psychologically the market is disconnected? Absolutely. And how can I play it? And that's how you execute it. And I guess a final point here is that we are bullish commodities by across the board. We like natural gas. We obviously like oil, but we're much more overweight natural gas. And we love the electric metals, and we are bullish on silver and gold as well. We think there's a lot of unique miners in the critical metal space, plus the precious metals that you don't have to get very far out the risk curve. Like, these are, like, you don't have to go buy big stocks. You can buy incredible mid cap miners that are on the verge of doing big things.
Excellent. Good words of advice. We'll give at least people something to go do homework on, right? If they haven't already. And then finally, last but not least, Peter, exactly same question, something that you want to talk about that we haven't talked about, or what investors really should be focusing on, over the next, 12 to 48 months, et cetera, and any words of advice.
Yeah, one of the things that I think investors, particularly in the energy space, need to be sensitive to is that with today's me here now thinking comes intense regionalization, nationalization, but a focus on things that are happening locally. Local wins over international and global, which means that if I'm a global energy company, it's going to be very difficult for me to be a slave of many masters who have very different views of what I should do. And so you want to be thinking about energy not on a global basis as a global trade as much as it is a country specific, and where do I think the interests of me as an investor will align with producers and policymakers in those countries. Because what you don't want is to be caught like, the fast food companies were in Russia when sentiment changes and being global becomes a disadvantage rather than being an advantage.
Good words of advice. And with that, I want to thank everybody that joined the space today to listen, especially our speakers. Thank you very much for taking time out of your busy day to talk to us all. We really do appreciate it. Follow Place Your Trades to see what else we have going on. Definitely follow all these speakers. They're fantastic. They have great stuff in their streams available, and I follow them all. They're wonderful, so I suggest that you do too. And with that, I also put the link to the PDF sign up in my Twitter stream. It's also in the Nest, which will disappear as soon as I end the space. But again, thank you everybody, particularly our speakers. Follow everybody, and we'll see you guys next Wednesday. Thanks, everyone.
Thanks, Tracy. Thanks, everybody.